Good morning and welcome to today's Premium Account Short Form Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The format for today's presentation, I'll quickly summarise the macro update. We'll move straight into the ASX top 50 stocks. We roll through the stocks that we're active in with a particular focus on looking now out towards 2014 earnings and how companies are sitting from a valuation perspective relative to their earnings growth and dividend yield out into 2014. We look at the recent transactions both on our internal account and client accounts and conclude with the short-term market outlook. The Investor Signals Premium Account service is designed for investors seeking a model portfolio of ASX top 50 stocks. We utilise the benefit of call options to enhance portfolio returns. We're very much focused around effective ownership around ex-dividend dates, and that as a combination of the call options and the effective ownership around dividend date, we drive above average cash flow from our model portfolio while still providing an opportunity for capital growth. The model portfolio is under a strict investment mandate, therefore suitable for self-managed super funds, and the assets remain in your name at all times. Presented today, myself, Leon Hine, and if you'd like to contact me, leon@investorsignals.com. Moving straight into a graph today, and I'm just going to kick off by going straight into AGK, and as I roll through the top 50 stocks, I'll come back and summarise some of the macro events hitting equity markets at present. So AGK came out with earnings result that disappointed a little. They were on the outlook for 2014 is reasonably flat. The stock trades on about 14 times forward earnings, around a 4% dividend yield. Over the next 12 months, we look for about 5% earnings growth out of AGK. We own it at lower levels. We've sold the covered calls up at around $16.50. We've just collected the 30-cent dividend from AGK. The stock should find support at or near this level. Asiano, disappointing result in earnings season, limited revenue growth, a real focus on cost control to meet the earnings target that the market was anticipating. Not seeing a real catalyst here to drive Asiano in the short term. Amcor, I think on this pullback to $10 is a very strong buy. I think if we look out 12 months, Amcor could easily trade back to $11.25, so around $10 is support. So for portfolios that don't own Amcor at the moment, we're keen on accumulating it. It's on about a 4.5% dividend yield, allowing for about 10% earnings growth into 2014. Trades on a PE into 2014 of around 15 times earnings. AMP starting to look interesting, but we're not doing anything there at present. ANZ, we continue to like this. We own it at lower levels. We're staying long the banks, arguably up to maybe another 5 to 10% upside in this current rally. ANZ should deliver about 5% EPS growth, and it's trading on a 5.2% dividend yield into 2014. ASX, a bit of a standout result within earnings season, caught a few analysts by surprise. The stock's just gone ex-dividend on Monday, approximately 88 cents. See it as a strong buying opportunity for portfolios that are underweight ASX. We're strong accumulators of it after this ex-dividend period. But broadly speaking, we own it already in most portfolios. We own it from lower levels. We've sold the calls up at around $37.50 to $38.50. We collected the 88-cent dividend. We got good call premium for those. So this is one of those names where we're driving sort of in excess of 10% cash flow as a result of the dividend and the call premium. I think ASX can push higher. If we go out 12 to 24 months, I'd expect ASX to be trading above $40. So we continue to look to stay long that name. Trading on a PE of about 19 times for 2014 earnings, and just nearing on a 5% dividend yield on those forward earnings outlook. AZJ, we continue to like this name. We're long the stock from lower levels. We effectively have an exit price up at around $5.50. They're in AZJ looking for about 10% EPS growth into 2014. BHP, again, we own this one from lower levels. We've capped it out around the $40 level, effectively giving us an exit around $40.50. The stock's gone ex-dividend, allowing for it from really where we sit here in the March quarter. moving into the June quarter for the stock to trade up to as high as $40, $41, but not seeing too much more than that. I think in the short term, generally, these resource names have probably had their run, and some of the other areas of the market will probably outperform over the coming months. Bramble, so we like this name. We're long this stock at lower levels here, about 8 to 10% earnings growth into 2014. The stock trades on 19 times forward earnings and about a 3.2, 3.3 dividend yield. So it is getting expensive up here, hence we've been capping out the gains at around this 9.50 level. The stock's yet to pay its dividend. It'll pay on Friday roughly 13.5 cents. CBA, we like this. I think off this level here around $95, the stock can trend a little bit higher up towards $78 towards the year end. To put some numbers on this, it's on a 5% dividend yield based on about 5% earnings growth into 2014, trading 15 times earnings. So from historical levels, certainly at the top end of its valuation range. But all the residential construction data is continuing to look very strong, and we're seeing obviously improvement in mortgage growth here in Australia. Coca-Cola, disappointing earnings results, underlying business falling by about 10%. On a forward outlook, the market's repricing on the basis that Coca-Cola will deliver flat growth in the 12 months ahead. That puts it on about 15, 16 times forward earnings on about a 5.5% dividend yield. I think its value down here, I think it can trade back up to around $12.50. We have sold calls up at around this level, collecting good premium. So into the middle of June, we're allowing Coca-Cola to rally back up in around that $12.50 range. Computershare, not a bad earnings result out of Computershare, a little bit of limited sort of revenue growth. A couple of areas of the business had declining profit margins, but on the whole, Computershare delivered in line with analyst expectation, trading about 19 times forward earnings on about a 2.5% dividend yield. I think it's expensive up here, but probably the macro environment with equity markets trending higher, we may not get the pullback down to the level we wanted to see to re-enter Computershare, but we'll continue to watch that one. CSL, continue to like this name, but on 23 times forward earnings on a 1.7% dividend yield. Yes, there's 10% underlying earnings growth in the business in the 12 months ahead. The share buyback that the company's doing is adding sort of buying pressure to the stock, but certainly getting up at the top end of our valuation range. We own it at lower levels. We sold the $71 calls, which gives us an effective exit up here at around $72, so not looking for CSL to trade too much higher in the near term. Crown, another one of those names, we own it at lower levels. This is more of a trading stock for us, up at around $18, $18.50. We look to take profit on Crown. On a forward outlook, Crown should deliver about 15% earnings growth. We have it trading about 20 times earnings on a 2% dividend yield. Just skip through a couple. Goodman Group within the property trust space, looking for forward earnings growth around 6%, trading on about a 4.3% dividend yield into 2014. Between sort of this $4.80 to $5, it gets expensive over the next sort of 3 to 6 months. Don't see it doing too much more than that. GPT's been one of our preferred property plays. We own it at lower levels here. We've capped it out at $3.70. We've got good income for that, so we're getting an effective exit price up at around $3.85 here in GPT. I think that caps sort of this current recovery. That'll put it on about 15 times earnings and back down at a low 5% dividend yield if we see it trading up at our target there around $3.85. If it doesn't, if it just bumps along sideways, a combination of that call premium and the dividend income, we're getting about 12% cash flow per annum out of GPT. Its underlying earnings growth should deliver about 4% to 5% earnings growth in the 12 months ahead. IPL continuing to look strong here with IPL from a valuation standpoint, compressing down to about a 3.8% dividend yield, about 14 times forward earnings. I think here at around sort of somewhere between $3 and $3.20, I'd expect it to run into some short-term resistance. There is a little bit of a short squeeze happening here in IPL. I think it's catching a few market sort of bears off guard who were running shorts across IPL. Lendlease, a little bit disappointing on the earnings front. The market was looking for a little bit more in the way of growth. The forward outlook statement from the company remains positive. The stock's on 12 times forward earnings on about a 3.9% dividend yield. We own it here at lower levels. at the top of the rally here, we'd sold the covered calls at $12. We got good premium for that, so we've collected the call premium, we've collected the dividend. At around $11, the stock should find support. I think the range is 11 to 11.50 for it to consolidate, but ultimately over the next 2 to 3 years, I think Lendlease will become a bit of a standout performer, should deliver sort of 10% capital growth to 15% capital growth out of Lendlease each year over the next sort of 3 years. Not doing there in Macquarie. NAB, we continue to like NAB, will be probably Westpac is our preferred exposure within the banking space. But again, around out of all the banking stocks, NAB delivered the least in the way of earnings growth. At 5.5% dividend yield, probably somewhere in the order of 3 to 5% underlying earnings growth, improving outlook in Europe, which in particular has reference to NAB's UK exposure. I think NAB can trade higher in line with our broader view on the banks. We're giving them a little more headroom before we start to cap out the gains in the banking stocks. Newcrest Mining, I've chatted a fair bit about this, obviously improving production numbers, improving gold price. Generally, I think Newcrest should be able to settle somewhere between this sort of $12 to $15 with gold trading around 13 to 1400 an ounce. Origin, so getting a little bit expensive. Origin, and to put some numbers on this, is 20 times next year's earnings, and that's allowing for about 5% earnings growth. It's on a 3.4% dividend yield, so that feeds into our view that we were buyers of it here at lower levels. At $15, we've been selling covered calls. We collected the recent dividend of 30 cents, which is giving us an effective exit price with the call premium up here at around $15.50. I think that caps the upside near term, but again, over the next 2 to 3 years, Origin should continue to perform very well, and it makes sense to have exposure to it in the portfolios. Oil Search, we're buyers of this off this sort of low $8 range, see it trending up to around $9.50. Not doing there in Qantas. QBE, slightly better earnings outlook for QBE, not doing anything there at the moment, but the stock sort of starts to come back onto the radar, as does AMP. Rio, we've steered clear of Rio in preference of Woodside Petroleum and BHP, but certainly Rio and BHP were standout earnings results within the earnings season, with a lot of the growth coming from these names as we had anticipated. But I think the bulk of this price adjustment's already happened. We're looking for more of a sort of a sideways consolidation out of BHP and Rio over the next few months. To put some numbers on Rio, it's trading about 10 times next year earnings on a 3% dividend yield, and that's allowing for about 10% earnings growth into 2014. Stockland's trading 16 times forward earnings on a 6% dividend yield, looking for about somewhere around 8% earnings growth out of Stocklands. We own it at lower levels here. We've been waiting for it to rally back up to around $4, where we'll look to sell the $4.10 or the $4.20 calls. Stocklands pays its dividend a little bit out of sync, so we wait until June to collect the dividend there on Stocklands. Sonic Healthcare, starting to put this name back on the radar again at around $17. I think the stock becomes interesting, selling covered calls up at around the $18 level there in Sonic Health. Trades about 17 times earnings on a 4% dividend yield, looking for just somewhere between 5 to 10% earnings growth in the 12 months ahead. Santos, 19 times forward earnings at about 2.5% dividend yield. I think we're probably getting pretty close to where we start to see some value unlocked in Santos. Down here, I think it's a reasonable buying opportunity. We're probably looking for something in the order of $14.50 to $15 in Santos in the months ahead. Generally, the oil and gas space across sort of Santos, Woodside, Oil Search, and exposure into BHP, I think makes increasing sense at this point in time in the economic cycle. Suncorp, nothing there at the moment, nor in Sydney. Transurban, we continue to like this name, so we've been buyers of it down here at around this 675, 680 level. We've been letting it rally. We've just capped it out at 725. We've got reasonable premium for that, giving us an effective exit price of around $7.50. So again, this is one of those situations where if the stock was to move sideways, we're driving around 10 to 12% cash flow out of holding Transurban, or alternatively, if we do get knocked out on the call and we have to deliver the stock, we own it at lower levels, so the capital growth that we've delivered through Transurban, I think, is being or will be quite appealing. The probability, though, is that the stock bounces sideways. The yield's compressing down to sort of low 4.5%. And we're only seeing modest increases in the dividend expectation over the 12 months ahead. Telstra, so put some numbers on this, 15 times forward earnings. We've seen the dividend just increase slightly from around 28 cents to 29 cents on an annualised basis. The company should deliver somewhere in the order of 3 to 5% earnings growth, probably more, at least 5% earnings growth in the 12 months ahead. It puts it on about a 5.5% dividend yield. I think Telstra could probably compress a little bit further, so the range becomes from here back up to around 5.50. Has just gone ex-dividend, so the expectation is that slowly starts to recover that up to around 5.25, but by year end I think it certainly could trade 5.50. Toll pays its dividend on paid its dividend last Thursday, I should say, 13 cents. The earnings result was a little bit disappointing out of Toll. The market was not expecting a lot in the way of growth, but in actual fact we saw a slight contraction in earnings. On a forward outlook, the market's sort of repricing Toll on the basis that earnings in 2014 are no worse than 13. If we start to put some numbers around that, it puts a stock on about a 5% dividend yield, about 13 times earnings. We've always sort of been of the view that 5.50 is full value for Toll, so where we own it, we're selling the sort of 5.75 calls now over Toll. WBC, our preferred banking exposure, we own it here at lower levels. We've just started to cap it out at around the 35.20 level into the end of September. We'll collect the upcoming May dividend, so effectively giving us an exit price up at around $36. I don't see Westpac delivering too much more than that, and again through the dividend and that call premium, instead of sort of getting the standard dividend yield of around 5.5% on Westpac, we're now driving that cash flow up to in excess of 10% and owning it at lower levels here and having the opportunity to deliver it up at $36. The underlying business should deliver about 5% earnings growth. WDC, on a forward outlook, we're looking for around about 5% earnings growth. It's trading 15 times earnings on a 5% dividend yield. I think it can trade back up towards $11, and then we sell the 11.50 calls to complement the income there on WDC. Wesfarmers, underlying business growing somewhere close to 10%, and I think on a forward outlook we can expect something the same, around 8 to 10% earnings growth. Puts a stock on 19 times current earnings on a 4.5% dividend yield. That's allowing for that growth into 2014. So it's fairly expensive on any measure, but a robust story and a defensive income stream here through owning the stock at this level, selling the covered calls up at around the $44 European style into sort of the latter part of the year, driving again in excess of 10% cash flow and allowing for some capital growth. So we continue to like the opportunity there with Wes, albeit recognising that's getting at the top end of its valuation range. Very similar story here with Woolworths, underlying business growing about 6%. Woolworths pays its dividend next Monday on the 17th. The dividend roughly around 70 cents. From an earnings perspective, the company should deliver, as I said, about somewhere between 6 to 8% earnings growth. It's trading about 18 times 2014 earnings. It's compressing down to less than a 4% dividend yield. I'd expect once the stock goes ex-dividend that it probably settles back down around this $35 range. We've capped the calls out at around $35.50, so we've collected the call premium, we'll collect the upcoming div. We own the stock at lower levels. I think it sort of fits within that range where it largely moves sideways, and we drive sort of the 10% plus cash flow out of it, but also have the opportunity for capital growth from owning it at lower levels. Woodside Petroleum, got two to go here. Woodside Petroleum trading about 12 times earnings on a 6.5% dividend yield, looking for earnings growth on a forward outlook somewhere in the order of 10%. I think around $40 is full value, and we're happy to cap out Woodside up on near that level. Westfield Retail Trust, not too much in the way of earnings growth over the next 12 months, trading 15 times earnings on a 6.5% dividend yield. We own it at lower levels here at around $3.20 to $3.30. Start to look to cap the gains there in Westfield Retail. And conclude today with a short-term outlook. So we've seen at a macro level improving economic data out of in the way of manufacturing, pretty much out of all areas of the world, and I think we're likely to see more synchronized global GDP growth, as I've been chatting about, especially as we get into the back half of this year. So equity markets remain well underpinned by central bank policy response, and I think, albeit whilst valuations are relatively high, the prospect of seeing growth like we've seen over the past 2 or 3 years, I think, starts to moderate. But again, equities are well underpinned in the right asset class to have exposure to, especially when complemented with the covered call strategy that we're running. If you'd like to know more about the Investor Signals model portfolio, please feel free to either log on and visit investorsignals.com or contact me on the details below.